Welcome to this presentation on tax planning basics. Hi, this is Joe Taylor with Oak Street Advisors. If you found this video, you must have concerns about income taxes and their effect on your financial fortunes. Saving and investing without considering income tax implications can be a bit like driving your car with the parking brake on. It slows you down considerably and is really bad for your car. In this video, we will give you an overview of some smart tax planning strategies that can help you keep more of what you earn and grow your financial wealth. Tax planning is a complicated endeavor, and no short video can teach you all the techniques available, but this is a good place to start, so let's get to it. In the United States, work is taxed at a higher rate than wealth. Yes, work is taxed at a higher rate than wealth, so that means you need to try and convert as much of your income into wealth as possible if you want to find true financial freedom. Here's a table of the 2020 income tax rates for single and married filing joint taxpayers. A couple filing jointly can have taxable income of up to $80,250 and pay no more than 12% for federal income taxes. Now that doesn't include the 7.65% that's deducted for Social Security and Medicaid contributions, nor does it include any state and local income taxes that may be due. If the couple claims a standard deduction of $24,800, they can have up to $105,050 in gross income without moving past the 12% federal marginal income tax rate. So the couple's $105,050 of gross income is reduced by $8,035 in payroll taxes, $9,235 in federal income taxes, leaving them with net income of $87,780. If that same couple had been successful at converting their work into wealth and had the same gross income of $105,050 that came from capital gains and qualified dividend income, their income tax rate would be 0% on $104,800 of income and just 15% on $250 of income, leaving them a total tax bill of $37.50. Spendable income after work, $87,780. Spendable income from wealth, $105,012.50. It may make no sense at all, but here we are. Understanding the difference in marginal income tax rates is important to understanding income tax planning. This table has been adjusted for gross incomes of individuals and joint filers who utilize the standard deduction. We've taken this format because most wage earners now take the standard deduction, and when they talk about income and taxation, most people think in terms of gross income they receive from their employers. Your marginal income tax rate is the percentage of taxes you would pay on $1 more of income. If you do not itemize deductions, just add up your W-2 income and find that income in the table below. Your first step is to find ways to lower your reported income. Contributing to tax-deferred accounts like an IRA, a 401k, and a 403b can reduce your current income tax liability, but it also merely pushes the problem forward. Eventually, the funds in these accounts will be subject to taxation. If you're in the 12% or a lower bracket, we would definitely recommend you forego the income tax savings today and move to a Roth 401k or a Roth IRA account to generate tax-free income forever after, or at least until they change the rules on us again. If you're saving for a child's private school or college education, or if you're paying off student loans you may already have incurred, using the 529 college savings plan is a great choice. You may receive a state income tax break for making the contribution. The growth in the account is tax-free for as long as the funds are spent for qualified education expenses, and that includes up to $10,000 a year for private elementary and high school tuition and a $10,000 lifetime limit for student loan repayment. For fixed income investing in taxable investment accounts, consider using tax-free money market funds, municipal bond funds, and qualified preferred stock offerings. Each of these options provide tax-advantaged earnings with no or lower income tax liability. Owning your own business or generating income through a part-time business that provides 1099 income rather than W-2 income can make you eligible for the qualified business income deduction that reduces the taxable portion of your business income by 20%. If you're covered by a high deductible health insurance plan, Be sure to take advantage of health savings accounts. You can make tax-deductible contributions and withdraw those funds income tax-free to cover qualified medical expenses. This is a real win. Tax-deductible means you pay no taxes on the income now, and tax-free withdrawals allows you to pay no tax when you spend the money. If you're over 70 and a half and make contributions to a charity and have an IRA, be sure to have the contributions originate from your IRA account. You can contribute up to $100,000 annually from your IRA and never pay income tax on those funds. You made the contributions on a pre-tax basis, they grew tax deferred, and now for qualified charitable distributions, they are not included in your income upon withdrawal. Be realistic about your income tax planning strategies. You cannot make all your income tax-free, but you can, to a degree, manage the brackets you fall into. Paying taxes at 10%, a 12%, or even a 22% rate could be wise. Today's income tax rates are low by historical standards, and the tax laws that have lowered the rates and expanded the brackets are due to sunset in 2025. Use the time between now and then wisely. Location, location, location. You've undoubtedly heard that mantra in the world of real estate, but it's also true in the world of investing. Where you own different investment assets can greatly enhance or curtail the after-tax returns of your portfolio. I'm often stumped when I find people obsessed with trying to beat market returns, yet giving no thought to what they're losing to income tax drag. If you earn 10% on an investment but got to pay 30% of that in taxes, you've really wasted a lot of time and effort and added meaningless risk to your financial life. You should locate tax-preferred investments in taxable accounts. That means tax-efficient index funds, growth stocks, municipal bonds, qualified preferred stock issues, and the like in your taxable investment accounts. Taxable bonds, CDs, income-producing stocks are better choices for tax-deferred or tax-free investment accounts, like your IRA, 401k, or 403b. Again, for appropriate goals, utilize 529 savings plans and health savings accounts. Opening a Roth IRA is a must. Unfortunately, the income tax code is long and complex. Although it's not easy, you must keep up with the changes to get the most from your tax planning efforts. Start early. The earlier in the year you begin to plan for income taxes, the better your outcome. There's very little you can do in December that will impact the tax liability that you've accumulated throughout the year. Do the simple things. Don't forget the basics. Offset capital gains with capital losses each year whenever possible. Make charitable contributions with shares of appreciated securities whenever possible. Fill up low brackets with Roth IRA conversions. Keep up with the items that can be deducted from your taxable income. Set up accounts for your children. They can have up to $1,100 of earned income each year without any income tax implications. We hope you have found some useful ideas here. Click the download button below and we'll be happy to send you a free copy of the material we have covered in this presentation. Your free copy will include helpful links where you can explore in depth any information you find useful. When you click the link and sign up for your free booklet, we will also include a Roth IRA flowchart that can help you know if you should make a Roth IRA contribution or a traditional IRA contribution this year. It will also help you determine if converting some of your existing traditional IRA funds to a Roth IRA is a smart tax planning move. Thanks for joining us, and best of luck in finding ways to reduce your income taxes.